Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good day, all. Ira Epstein of Linn & Associates with your metals market update for this Monday, and we're at December 17th, 2018, just after 2:50 p.m. Central Standard Time. I want to remind you all, this is our last full week of trading for a while, right? We've got Christmas, then New Year's, so you're not going to have full weeks. You're going to see traders by the end of the week cashing it out. This is the last week for a lot of the traders. They'll close their books up and then move on into the end of the year. Trading won't stop, but if you're asking me if you made your money for the year and lost your money, it's probably more done than not, and that's what traders are looking at. I know I was interviewed today on the gold market by the Wall Street Journal. They had called, "What do I see?" And what I told them in a nutshell is, tell me what the dollar's going to do, and I'll tell you what gold's going to do. What I am noticing is that so many of the investment houses are now predicting a weaker dollar for 2019. If they're correct, and I got to tell you, if you read their corrections from last year to this December, they didn't have such a good record. But if they're correct, well, then I'm friendly the metal markets. I think a lower dollar will help world trade. Obviously, another thing that could help in 2019 would be U.S.-China trade relations taking a turn for the better, not the worse. We're not seeing an impact, as I see it, on gold from Brexit. We're not seeing it on other calendar events. Gold held up today well when you take a look at energy prices, which cratered down $2 a barrel. If you take a look at the weekly area chart of gold, we're going to finish off very close to that 1246.80. That was a couple week ago high. You can see where you're at right now. When you take a look at how the markets come, we're into a resistance area. We had a correction phase, and now the markets jumped back. We need to take out 1252.60 to end that correction phase. What's a correction phase? A pattern of lower highs, lower lows, when prices are over the 18-day average of closes. Now, when you get those, you don't always go back to the 18-day average of closes, the red line, but you know how often you hear me say in these videos that that is what I call the line in the sand. Markets like to get to a number that they're comfortable with to figure out what to do next. On Friday you fell there, now you're getting your bump. To get bearish on gold, you need to close now under this 18-day average of closes without taking out 1252.60. If you take out 1252.60, to me it's a proxy that the bulls don't want to let go of the uptrend that they've got in hand. The problem for the bulls is the upper Bollinger Band, this black dashed line that comes in at 1258.80, is waiting for them. And generally speaking, these first challenges, especially a challenge after hitting the 18-day average, the first challenge again of it, runs into resistance. When you get down to that number, you can run it. You ran it on the top side here, but notice where you came back to when you fought your battle. Eventually, markets leave these battle zones and they break out one way or the other. You just haven't done it yet in the gold. In terms of momentum, you are overbought. Any reading over 70 on the slow stochastics, either one of the numbers, the blue or the red, they're called the K and the D. In this case, they're both over 70, but either one being over 70 is overbought. So I have a market that's trying to stay with upside bias. It's overbought. It had hit the Bollinger Band about a week and a half ago, fell back to the neutral territory, and it's trying to grab some traction here. When we take a look at GLD, the popular ETF, today's high is 118.02, which, now I'm looking at this, it took this high out. So I have to take one of these arrows and have it point up from right here. That tells me that I've got a pattern of what? A higher high and a lower low. I'm not trending. I'm keeping the upside bias. If you look at today's low at 117.36, it got close to the 18-day average, didn't hit it. In fact, you haven't hit the 18-day average here. In terms of momentum, you had an embedded reading. You lost it on Friday, and today you've got it back. They've set up a bear trap. A trap happens when you lose the embedded reading, and prices often make a run then to the 18-day average of closes. It missed it here by a dime, 10 points, and now it's popped up and took out that high. It caught those people. So there's a difference between coming out of long positions and a difference between hitting that number. Right now with the embedded reading, the bulls take control until you close under that red line closes back under 80. If it does, then you have to play. And by the way, if it happens again like that, you rarely go back and embed the way that you've done. It's a sign of an internal weakness starting to happen. The strongest part of the market's the surprise, the gold miners. It has kept its uptrend. It has got its embedded reading. It's not trying to lose it. Next resistance, 2074. It stays bullish till that red line gets back underneath, until price get underneath the red. In the gold-silver ratio, you pretty well flattened out, but you come off the highs. And one of the things that I've been saying is, in order to get a bull market going in metals, you need those base metals to come alive at some point, and they've been doing that. Silver's been holding on, as you can see. It is overbought. It's got the lower low, higher high. The bias is up since it's over the 18-day average, and the resistance temporarily is the 100-day average, the green line you see. If it can clear that with any zest, well, then I'd look for the upper Bollinger Band of 1491.5. Let's turn the tide here. If prices get under 1456, the odds are that the 18-day average is going to jump tomorrow because it's been moving about 2-3 cents a day, penny and a half. That's going to put it dangerously close to 1456. Close under that number, and you'd have lower highs, lower lows. You'd actually get an all-out bear signal. So things that I'm watching. In the copper market, what did you do? You finally fell back to the lower Bollinger Band today, 271.80. You round up today's low, 271.95, so you fell into that zone, and you sparked back to the upside. You didn't quite get to the 100-day average. That'll be the first resistance in green at 276.15. Then the 18-day. This is just a market caught in whipsaw sideways action, not a trend. Now, one of the markets that I've been looking for better prices on has been the palladium. When you lose an embedded reading, and I keep saying that, and you don't gain it back right away, which you did not do here, often price and the 18-day average will make a run at each other. It's not over. It doesn't mean I'm right in saying that, but that's what I often see. In the palladium market, it is still, as far as I am concerned, the strongest of the bull markets. It doesn't even try to stay under the 18-day average of closes. When it does, I'll change my opinion. But right now, I think that's the strongest of the markets. And I've moved to the March dollar index. You should not be in the DCs anymore. The trend remains higher lows, higher highs. Price action has been hit. Don't be surprised to run back to the 18-day average to see what's next, and you're probably going to get this market in a very neutral state in front of Wednesday's FOMC financial announcement, monetary policy, and then seeing what Fed Chair Powell says. It's going to be really heavily watched. May not want to be in some of these markets going into that. I'm Ira Epstein. I want to remind you about our charting course special. Normally my charting course, it's 6 hours of videos. See what I do, you do the same. And the way it's done is this way. I include the data in the charting software that goes hand in hand with the videos when I recorded them. Then each morning, typically Monday through Friday, what I do is I'll record videos for you using the current data, and I'll say, here's this indicator, here's this one. You start understanding what is going on. I try to focus in. Then approximately every second or third week of the month, I do another thing. I hold a live webinar, and you can come in and ask questions, and you can always email me a question. I'll answer it. And by the way, I do pick up my phone. I know that sounds crazy in this day and life, but I'm somebody that believes that you talk to people. Look at the hair. You know, I remember a better day when we didn't have all this social interaction on the internet. You had to have skill in talking to people, and that was the fun of it. But in order to get this, and you can buy it as a gift, you can give it to yourself, you can give it to someone else, it's pretty simple. All you need to do is call my staff, 866-973-2077. You can go to our website, www.iraepstein.com. Under the word education, you'll see all the information, and you don't need a code. We've lowered the price for the Christmas special, and you can click up here to get to our main page as well. I'm Ira. You have a good day, and I'll see you tomorrow.